and welcome to the latest Insider interview. Our guest today is Roberta Barr, manager of the Schroder Global Sustainable Value Equity Fund. Roberta, thank you very much for coming to the studio.
My pleasure. Thank you for having me, Sam.
You run a value fund. You're looking for cheap, unloved shares. Why is that the right way of picking stocks? Why should we choose cheap shares rather than expensive, faster growing ones, or even just own the entire market?
So there's a really fun sort of stat out there, which I think might be interesting for you for this question. And it's, imagine that you were back in 1926 and your grandparents are given $10,000 to invest for you today. And let's say that your grandparents are really, exciting, innovative kind of people. And they think into the future and they think, oh gosh, all these exciting developments are underway. Remember at that point there wasn't the internet, cars were barely a thing, flights, international travel wasn't really a thing. There's a long way to go. So let's say that your exciting grandparents put that $10,000 into growth companies. They want to invest into that future for you. Well, then today you would be given just over $100 million. So, a great return, and certainly not one that I think many of us would say no to. But let's instead say that your grandparents are really boring, pragmatic people. They didn't want to invest in things that people were getting overexcited about and they didn't really know would work. Instead, they're going to put that $10,000 into value companies. Well, then today, you'd be given just under $1 billion. So an amazing return. And I think what it really highlights to us that over the long term, value works and it works spectacularly well. And even if we just look at each decade, going back again to 1926, then the last 10 years is the only 10 years where value has not outperformed growth. And in absolute terms, it still has had a positive return. It hasn't lost you money. I still have a job, but it hasn't done as well as growth. And I think we're all human, we're all subject to behavioural biases like recency bias. I think it's so important that we don't overweight the statistical significance of those past 10 years where value's had quite a tough time. And instead remember that actually the vast majority of history does lie in value's favour. So hopefully if you're patient and you wait it out, then actually you should appreciate those full returns that value can give.
And why hasn't value done so well over the past decade? You've underperformed your peers as these giant tech stocks have become more and more expensive, but they've actually gobbled up a lot of the market and increased profits as well. So why hasn't value outperformed, and why is value still the right way of investing?
So as you say, there are many reasons why value hasn't outperformed, and it's certainly been a really tough few years for value, which is not what we want for our investors. But I think so one point is that in absolute terms, we have still delivered quite a healthy return. It just hasn't been this, amazing return that growth stocks have. And I think as well that the reason you should still be in value is because when markets turn, they turn so fast and so unpredictably. If you just look at a few points back in 2022 when value snapped back, it really, really hurt some people who just weren't able to move their portfolios fast enough. And if you look at the charts of value versus growth in the long term and where value sits versus growth today, then if you think those small snapbacks hurt, then there is still a significant way to go to meet the mean levels of value versus growth. So, if that hurt, imagine how much this is going to hurt.
The fund is flat over the past 12 months. That's better than your global investment peers, but it's still not a positive return. Would you have expected more given the changes in market conditions, or are you happy with that performance?
Yeah, the portfolio is flat over, say, a year, and versus the benchmark, that's okay, that's pretty good, but you're absolutely right. We would want to be outperforming in absolute terms and giving a significant return in absolute terms. But if I look at how our sustainable value portfolio performed versus, say, our global recovery portfolio, then our global recovery portfolio had a very good year last year. It outperformed in both relative and absolute terms. And if I look at the differential between sustainable value and our global recovery fund, the whole difference comes from oil and gas. And that's exactly what you'd expect. As a sustainable fund, you can't hold oil and gas. So actually, you will always suffer from when there are oil price rallies, but also in the future, say if there are carbon taxes or windfall taxes, you won't suffer that hit either. So I think, what we say for what we roughly expect this fund to do is we expect it to perform well when value markets perform well, with the caveat that we're not holding sin business activities, and that can hurt or benefit in the shorter term. But it sort of leads me on to a point which I often get asked as a sustainable value investor, which is, you don't hold these sin sectors. Those are some of the most attractively valued sectors out there today. Does that mean that you're going to miss out on their attractive valuations and you're not going to be able to outperform? And you know what? They're right. Because as we all know, as soon as you start to reduce your opportunity set, you are reducing your potential for outperformance. But I think it's so important not to over-exaggerate that fact. So, if we look at a sort of proxy value portfolio going back 30 years or so, you'd expect that value portfolio, it sort of roughly outperforms its index by around 5.2% per annum. If you take that same proxy value portfolio and you apply a whole host of exclusions, so you remove all of tobacco, all of gambling, all of alcohol, all of oil and gas, utilities and so on, you're probably harsher than you'd actually find in a sustainable fund. That portfolio outperforms by 5.0%. So not the 5.2% of the unconstrained fund, but still a very healthy and not statistically significantly different excess out return.
And what are the main differences between your portfolio and the global recovery portfolio? Where are the exciting sustainable value stocks that make your fund a bit different, a bit special?
On the valuation side, it's exactly the same. On the sector side, we don't hold oil and gas. We also don't hold the sort of auto companies that they do in the Global Recovery Fund. But we make up for that in telecoms, where we can see some really great opportunities for ESG leading companies, which are also very attractively valued. And we also hold a bit more in things like healthcare. On the regional side as well, it's probably also worth mentioning that the Global Recovery Fund holds some emerging market stocks, which we don't hold in our Global Sustainable Value Fund for ESG reasons. But instead, we've made up that ground on, for example, Europe, where we do find that nice combination of ESG leaders plus attractively valued companies.
Have there been any new additions to the portfolio over the past couple of years or so, which you think will have a great short-term performance over the next few years?
Yeah, so the portfolio has only been running for a year, so all the positions are technically new positions. But I guess in the past few months, with market movements, we've certainly found a few new companies coming into our valuation screens which weren't there before, and which make quite exciting additions to the portfolio. So, for example, in recent months, we've added Verizon, which I think is a really exciting company. I can't say about performance in the next 1 year. We're 3 to 5 year investors. But I certainly know that it's a very nice US telecoms company that's made a very nice addition to the portfolio.
You've spoken about a bench of companies that you're watching, that you're ready to invest in if they hit the appropriate valuation. How many stocks are in that kind of backup list, and where are the sectors that you are excited about but haven't quite seen the valuations yet?
So, we have this bench of stocks, and it's the companies that we think could be interesting. They're maybe not quite at the right valuation yet, but we're certainly keeping an eye on them. And that bench is probably a bit longer at the moment than it typically is. And I think that comes from a lot of the market movements, like in the US, with a lot of tech stocks falling. And what I say is a lot of the FANG stocks aren't necessarily appropriate for a sustainable fund, but there are still some very sort of attractive on the edge companies which we're keeping a close eye on. So watch this space, but I think it's always it makes it interesting as a value investor that there's no company which is immune to finding its way into our valuation screen. There's no company which is so untouchable that in the long term is going to never fall out of favour in the market. I think that's what makes it really exciting as a value investor is who knows what's coming, and you'll probably see everything throughout your career.
You have a lot of technology in the portfolio, companies like eBay, IBM, Intel. These are what some might consider tech stocks that are past their best. They've had their heyday.
Yes.
So why do you still like them? Why are their best days ahead of them?
Well, look, they have had their day, but that's not to say they aren't going to have another good time. So, if we look at them, then firstly, they're often winding down perhaps the legacy parts of the business, but they've also got a lot of cash to start investing in new exciting areas. And so where we see the balance of a company where you're paying basically nothing for the existing part of the business, and you're getting this free option for what they could and should be able to produce, then I think that's the sort of company, exactly the sort of company that we want. where we know that the cash is going to kick out makes it fine as a company, good as an investment, but you have the sort of asymmetric potential return to the investment risk that you're taking on.
And finally, the question we ask all of our guests: do you personally invest in the fund?
Of course, I do fully invest in the fund, and I must say it's very nice as a value investor to finally have a fund where I can put my money into that value style without having to compromise on my personal ethics of not wanting to hold, say, tobacco, or a company which isn't doing everything that it can to remove human rights violations from its supply chain. So for me, it was really nice to finally have this portfolio there and able to invest in.
Roberta, thanks very much for coming into the studio.
Thank you for having me.
And that's all we've got time for today. You can check out more insider interviews on our YouTube channel, where you can like, comment, and subscribe. See you next time.